Welcome back today. We venture into the turbulent waters of the stock market drop, examining the underlying forces at play. Increasing concern and anxiety grip investors as the markets navigate through financial storm clouds. The question looms, are these reactions driven by fear, or does a more profound complexity exist? Tariffs, interest rates, inflation, and global events collide, igniting a landscape of uncertainty that demands close examination. Let's unravel these elements and equip ourselves with knowledge to maneuver through these challenging times. The emotional manipulation of investors is rampant, exacerbated by media sensationalism. Headlines scream of a market crash or an impending recession, fostering a dangerous climate of fear among retail investors. Such provocations can distort rational decision-making, coercing investors into impulsive actions. Beneath the surface, many financial analysts may serve hidden agendas, targeting market panic to facilitate advantageous positions for institutional buyers. As cooler-minded investors, it's crucial to filter out the noise, turning our attention to factual data that fuels informed decisions rather than succumbing to emotional upheaval. Tariffs have emerged as a significant trigger behind the stock market downturn, with recent announcements affecting imports from Mexico, Canada, and China. Tariffs, essentially taxes on imported goods, not only inflate costs for businesses but resonate negatively through to consumers. Designed to protect domestic markets, these measures can paradoxically strain economic growth by escalating the prices consumers pay for everyday essentials. The narrative that foreign exporters bear the brunt of tariffs often misrepresents the truth, as the burden ultimately falls on the shoulders of consumers, leading to less purchasing power and, thereby, a potential slowdown in economic activity. Looking back to 2018 reveals valuable lessons amidst the market's daunting fluctuations. That year witnessed a similar drop, prompted by tariff-related uncertainties, yet the market exhibited resilience, rebounding to record highs just 1 year later. Investors who seized the opportunity to buy during the dip often enjoyed substantial gains. This serves as a reminder that current panic may very well unfold into future opportunities, urging smart investors to remain steadfast during these fluctuations, rather than retreating into fear. As we analyze the current landscape, it's vital to recognize why 2024 presents a uniquely complicated challenge. Unlike previous situations, tariffs now encompass significant trade partners, namely Mexico and Canada, alongside China, introducing complexities that resonate across industries. With a staggering total import value of $1.6 trillion annually, the implications ripple through the economy, potentially leading to higher prices on essential goods. Thus, the game of investing turns increasingly intricate, pushing us to stay informed and navigate the emerging financial maze strategically. Rising interest rates have become a dominant theme in today's economic landscape, largely instigated by the Federal Reserve's aggressive stance on controlling inflation. This shift has profound implications for both consumers and businesses alike. Borrowing has markedly become more expensive, challenging those who rely heavily on loans to fund their operations or purchases. Tech startups, for instance, find themselves in an increasingly precarious position, grappling with higher costs of debt financing essential for growth and innovation. The realm of housing is also affected, as elevated mortgage rates deter homebuyers, resulting in a slowdown within the real estate market. The higher monthly payments discourage potential buyers, which in turn leads to a decrease in housing demand. This cooling effect creates ripples throughout the economy, impacting not just housing prices but also the industries linked to real estate, from construction to home furnishings, stalling their growth prospects. Simultaneously, shifts in investor sentiment become pronounced, as market participants often transfer their investments from stocks to bonds in response to rising interest rates. This behavior accentuates a decline in stock prices, driven by fears of diminished profits amid higher borrowing costs. Nonetheless, this reaction may overlook fundamental market strength, where many businesses maintain robust earnings and a healthy profit margin, providing a stark contrast to the prevailing atmosphere of fear. Navigating this volatility requires a strategic lens as investors consider opportunities amidst uncertainty. Market downturns can serve as an advantageous time to acquire quality stocks at discounted prices. Approaches like dollar-cost averaging allow investors to mitigate risks through regular investments. Moreover, focusing on fundamentally strong stocks ensures alignment with companies that are poised for growth, even in tougher economic climates. As market dynamics evolve, balancing different types of investments becomes necessary. Growth stocks, particularly in the tech sector, may present high volatility, but are positioned for potentially elevated returns. In contrast, value stocks, such as those found in banking and utilities, tend to exhibit stability during economic downturns. A diversified portfolio embracing both can buffer against unexpected market movements, ensuring resilience in shifting economic tides. Ultimately, understanding the interconnected nature of rising interest rates, market sentiment, and investment strategies is essential. As the Federal Reserve continues its battle against inflation, discerning investors recognize that periods of volatility can unveil hidden opportunities, allowing for informed decisions that yield long-term gains. The global economy is a complex web, and its intricacies can significantly impact the U.S. stock market. One prominent factor is the economic slowdown in China, which has sent ripples through international trade. With the real estate market there experiencing turmoil, it casts uncertainty on the stability of global supply chains and consumer demand, affecting American companies reliant on exports. Another critical element is the fluctuation of energy prices. Rising oil costs create a ripple effect, increasing transportation and production expenses across various industries. This uptick in costs not only pressures corporate profit margins, but can also lead to increased prices for consumers, further influencing economic sentiment and spending habits. Geopolitical conflicts, such as wars and political instability, introduce additional layers of unpredictability. Trade disputes and military tensions can disrupt markets, causing investor anxiety and volatility in stock prices. As global players maneuver their strategies, uncertainty can lead to knee-jerk reactions on Wall Street, impacting investments more broadly. Amid these economic headwinds, many investors draw parallels to the financial crisis of 2008, fearing a repeat of such devastation. Nevertheless, key distinctions exist today. Banks have fortified their balance sheets, benefiting from stricter regulations aimed at mitigating risk. Additionally, the housing sector lacks the previous vulnerabilities that stemmed from over-leveraging, positioning it as relatively stable compared to past crises. While some analysts posit that a recession is likely, widespread financial institution failures seem less probable. Today's market might experience downturns, but a significant financial meltdown appears unlikely, signaling to investors that caution is golden but panic is unwarranted. Looking to the future, the role of artificial intelligence and robotics emerges as a beacon of hope for economic resilience. Unlike bubbles of yesteryear, the current technological evolution drives genuine advancements across sectors. Companies investing in AI and automation showcase promising long-term growth potential, highlighting opportunities for savvy investors. In a bear market, avoiding common pitfalls is crucial. Selling stocks out of fear or attempting to time the market is often detrimental. It's essential to emphasize quality investments and maintain a diversified portfolio. While turbulence may dominate the headlines, patient investors often reap the rewards, capitalizing on discounted equities. In summary, while the stock market grapples with uncertainty, long-term growth persists. Viewing downturns as opportunities rather than threats can empower investors. By staying informed and focused on fundamentals, one can navigate through economic turmoil and set the stage for future wealth accumulation.